Say we snapped our fingers and doubled the amount of gold in the world. We'd expect the price of gold to fall. But what if I told you about a good where an increase in supply causes prices to rise rather than fall? That would be pretty weird, right? A strange good where more supply increases price does exist. It is one of the most ubiquitous and invisible goods of all: debt. Why would the price of debt go higher as the total supply of it increases? Let's take a closer look. Over the past 40 years, the level of debt has grown much faster than the global economy. What this means is that debt ratios have risen. The debt ratio is the size of the total debt issued by governments, corporations, and households, including mortgages, auto loans, and credit cards, compared to the annual size of economic output, or GDP. In debt markets, prices and yields move in opposite directions. If increasing debt ratios had caused the price of debt to fall, then interest rates and bond yields should have risen, right? Instead, they've fallen in almost every major economy. So why doesn't debt follow the laws of economics? Why hasn't an increasing supply of debt caused interest rates to rise? One major change in the world economy over the last 4 decades has been falling rates of inflation. With no risk of price inflation, central banks have been free to lower interest rates. These lower interest rates made it less expensive to borrow money, enabling a rise in debt. Here's the real story, according to an economist. The debt paradox is that as the amount of debt increases, the price of debt rises and yields fall further. This paradox exists because the only way that such high debt ratios can be financed is through near zero rates.